What we've already seen in 2023 is it's actually been quite a busy year for M&A, particularly the second half of the year. And obviously we haven't even finished the year yet, so straight after this I fly back to New York. We have a deal closing tomorrow, so still constant activity. A lot of buyers have been sat around somewhat patiently waiting for rates to either stop increasing or begin to decrease again. So many transactions we see are funded with a combination of equity and debt, so they're very sensitive to interest rates. So at least what we're expecting is if rates are coming down or even just stable for a little while, that's definitely going to help encourage activity at all deal levels.
Talk to us about the funding environment, given where rates have been and also the consequences of the regional banking crisis in the US from earlier this year. What does lending look like by and large across the banks?
So I think banks have certainly got more conservative. I think when we looked at banks like First Republic and some of the other issues, particularly in the US, that definitely caused a little bit of a slowdown for a while, where people started to be a little bit more kind of conservative with how they were lending. But ultimately, in the US at least, there's $4 trillion of dry powder with private equity firms. So if you actually look at how deals are really getting done, the majority of it is with those kind of dry powder needs to be deployed by these private equity firms. So yes, interest rates are important, but it doesn't mean deals can't happen if interest rates are increasing. So if you wanted to go to a bank to get funding, yes, that was a little bit more difficult, but I think if you want to get deals done, if you want to buy a great business, then there are ways you can get that funded. And that's never really changed in hundreds of years.
One would have thought, though, that the tech companies especially, in sort of seeing the valuations that we have seen, would want to get into a little bit more deal making, maybe getting into next year, shoring up their investments, growing even better as businesses, perhaps streamlining some manufacturing processes or whatever the case might be. But you reckon that they'll actually not want to part with much of their capital. Why do you think that is?
Well, I think companies will still be doing deals, but I think regardless of what's happening in the market, if acquisitions are part of your strategy, you still need to be buying good businesses. You don't just deploy capital or buy businesses just for the sake of it. If you're not buying, it's the same with any kind of investing. If you're not buying the right assets or the right businesses, it's not going to be a great strategy for you. So I think deals will still be happening. I mean, we see a real mix of private equity firms, public companies, kind of private companies that have raised funding doing acquisitions. So there's a real broad range. So I wouldn't necessarily say there's kind of going to be an increase or a decrease in a certain area. It's just going to be, I think, overall a pretty good year for everyone.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.